Cliff Investor Show. I'm your host, Marquise Harding. Sorry I've been gone for about a month. I've been caught up in school and family life. Uh, but I'm back. I'm trying to pump out these videos as best I can. I'm gonna try to do it at least once a day if I can. And if I can, twice a month or twice a day. But, but yeah, just know that I'm busy with school and with work and family. But I'm back to make these videos. Today, you see in front of you my new updated evaluation model. How I evaluate stocks. Sorry, I just got off graveyard, so my tongue is not working correctly. But today, I'm gonna start off with Apple. Apple is the largest holding in the SP 500. So let's begin. You see, we have these categories: revenue growth, profit margin, gross margin, net income, net margin, free cash flow growth, price to free cash flow or sales to free cash flow yield, debt to free cash flow, shares outstanding. I like to have the percentage of shares being bought back right here to show me how much as a stockholder am I gaining. Return on invested capital, return on equity. And you see down here is the current price of Apple, where I think the intrinsic value is, or the fair value, and the margin of safety value as well. Also tells me if I need to buy or sell, and if it's the upside or downside. But you can see the past in over 5 years, I like to use the measurement of 5 years to base off of everything money. Everything money likes to critique a stock that has 5 years of data at least. So you see, 5 years ago to now, the revenue growth has grown about 41%. Profit growth at about 44, almost 45%. Profit margin has increased by 94%. Gross margin has increased by 61%. Free cap, sorry, net income growth about 41, sorry, 43. Net margin 72. Free cash flow about 77. Price to free cash flow is actually at 18. And all that, I'm just read all this really quick. Then I'm gonna go through and tell you the metrics I use to um, critique if it's a good or bad number. The yield on free cash flow is 5.8%. Their debt to free cash flow is 1.73. They are buying back about 5,182. When in actuality is roughly about 5 million or 5 billion shares. And they're increasing the value of their shares by 31%. And you can see over the 5 year growth, the return in invested capital is about 24%. The return on equity is 65%. So revenue growth, profit growth, net income has to be above zero, which we see. Profit growth, let's just check this out real quick, is over zero. Gross margin, I have set it to over 40 to be a good valuation of gross margin. If it's less than 40, that's pretty worrisome. Net margin has to be over 20. You consider as a good margin, and less than 20 is pretty bad. Free cash flow has to be over 0. If anything over 15, for example, 16 and above, um, then it means that the the management team hasn't really managed the sales to free cash flow that well. I use sales to free cash flow or price of free cash flow more than I use PE. Because it seems like there's a better, more accurate number of the growth of the company. Because free cash flow is king. So just to have a low price of free cash flow, that means they're able to manage their free cash flow better than if it's high. It means they are not understanding or they not managing the free cash flow well, or just they're just not able to manage their money. But Apple's is a different story because it's 18.8% or zero point 0.8. That is very I let it slide because it's close to 15 is manageable. Free cash flow yield needs to be greater or equal to 5%. We see Apple's is. Debt to free cash flow means how much of the debt can be paid off with it, or sorry, how much can the total debt be paid off, or sorry, how long can the debt be paid off with free cash flow? And for Apple, it's about 1.73 years. We want that under 5. Why? Because we're calculating 5 years. You see that return on equity needs to be over 10 to be a good valuation. Same thing with the equity needs to be over 10. All right, let's look at the discount cash flow model. So here it is. I'm using Jacob Morrison's discount cash flow model, and I actually like it. I like it. I don't have to add do that too much. The way I have set up my evaluation model is that all I have to do is put in. So I get copy from stock and analysis platform. This copy, drag all this out into my valuation model, into the income for when I'm dealing with income, balance, free cash flow model, ratio, and we'll auto populate these cells. This one, really the only ones I really have to put in is the analyst expectations or the forecast for the future. You see here 401.89 or $0.9 billion in 2022, 23 for 424.5 or just say $0.6 billion. Sorry, to 123. Sorry, 2023. I just put it here and it gave me the value. Also, today's value should be about roughly the same as the market cap. A little under. Yeah, a little bit under. But that should be fine. So it gives me the fair value of the company at $87.36. That's even with a 12.5% rate of return. I want a rate of return of 12.5. I agree with uh, Paul of Everything Money. Is that you can get 10% if you want to match the market, but I want to beat the market. I want to beat the index. So let's see, 10%. Still not a buy. About 7.5. That's roughly the average return of uh, actively managed funds. 7.5 is a buy. 8%? Oh, buy still. 9. Uh, so somewhere between 9 and 10. Oh, where is that lucky number? 9. Alright, whatever. Yeah. But for me, Apple needs to fall about 36.3% more to reach my fair value of 87.36 for me to have a release of buy at that rate. But then my margin of safety is 56.79. I like to do a big, large margin of safety because I don't know how the market's gonna be. I can't judge the direction of the market, so I just like to have a large um, margin of safety. So right now, the current price is $137.13. My fair value is at $87.36. So it needs to drop. Let me see. Make sure I. Yep. It needs to drop over half for me to buy into it. I mean, I have shares into Apple, not full shares, but I'm dollar cost averaging into Apple. But for me to actually look at potentially buying a full share of Apple, I need to drop about 57%. But let's count it up. I like using green and red because it helps me to figure out what I consider as the gut check score. The gut check score is simply this. It is a metric I have used or I came up with. I'm still a work in progress of how accurate this is. But simply, a gut check score is how good out of 13 your stock is. The higher the number is, the more likely the stock will be fine in a bear market, which we're in. That's why I'm redoing all my evaluation because we're in a bear market. So, so we have a 12 out of 13 because of the price of free cash flow. It was a little high, still counts. So we have 12. You see, we have 12 out of 13. We have 92.31%. So we just log it here. Just and we rate the time. I'm drawing blank. Sorry. Oh, be 6, 13, 22, pre-market. So that's it. That's simply my new method. Also, here's the little thing about a 5 years summary, so you can visualize it more in detail. I also do have PE if people want to look at the PE ratio. This will all populate. as well with the income, balance, and free cash flow and ratio sheets or statements. But um, sometimes the return on invested capital, ROE, PE, and the price of free cash flow will have an error, but there's nothing too serious. Just all I do is just make sure that they're reconnect to the source, which is these statements. But that's pretty much it for my new, what I consider the clear picture evaluation. Some may think that's too many evaluation metrics you use, but I say it helps me to have a better view. I use all this as a filter, like one giant filter, and these help me to have a better understanding of the company, as well as to filter out the noise. Well, you take care. And we see Apple has a 92.31% gut check score, which means they're not gonna fall drastically. They will fall, don't get me wrong, all stocks will fall, and they'll go back up, but it depends on how far. But you take care. See you, investors.